get nervous every time that countdown happens.
You should. Oh, Zama Bamboo.
Seriously? You got to no, Merlin. Good God.
That's pretty good, though.
We're idiots, by the way. The pod's called Total Idiots. We just use Real Estate Insiders Unfiltered.
You know, that's a successful podcast strategy. I've seen a lot of it.
There, yeah.
Yeah. Titled one thing, but it's really another.
Yeah. Just be idiots.
On this episode of Real Estate Insiders Unfiltered, we talked about the commercial real estate sector. We broke each part of that sector down. We also addressed the $650 billion problem that is ahead of us potentially, including regional banks. Going to be an incredible show. Tune in. You talk about it privately. We talk about it publicly. This is the Real Estate Insiders Unfiltered podcast. Welcome again to the Real Estate Insiders Unfiltered podcast. I'm your host, James Dwiggins, along with my co-host, Mr. Crazy Uncle Keith. I've given up on calling you Keith Robinson, by the way.
That's fine. Seems like most people have.
That's basically the truth. So yes. We had David Bitner, the executive managing director and global head of research for Newmark, one of the largest commercial real estate companies in the world.
Yes, he was awesome.
Yeah, it was great. Yeah.
We got to nerd out on big words, military history. He had some of the best answers to our rapid fire questions that we always start with. And being a commercial real estate head of research for a massive company, he unpacked for us all of each sector of commercial real estate, a $650 billion potential problem that could be looming. How you could fix something by maybe just ignoring it, and the importance of data and how it drives everything. It was a great conversation.
He also dropped a few F-bombs, just so everybody knows. I did not. So
no, you were good.
I was great.
You were good.
But it's a great show, everybody. Tune in. David, welcome to the show. We are excited to have you. A little backstory for viewers and listeners. Keith and I have been wanting to get somebody on the pod to talk about commercial real estate. We reached out to one of our really good friends on Wall Street, and he's like, you guys have to have David. And so David agreed. You're an expert in this space, and certainly there's a lot of headlines around commercial real estate. I don't think yours are as bad as residential real estate today, but you have some headlines that are going on about the that side of the business.
Whoa! Hey! We've got much worse headlines. I mean, your sector. Well, I guess it depends on the perspective. Y'all got a bunch of 30-year debt that nobody has to refi.
Here's one headline: office market collapse, commercial foreclosure spike 117% in 1 year. Yeah, their headlines are
pew. Yeah. But then keep in mind the news just did that, so it went from 2 foreclosures to 3, and so now it's So David, we always start with this just so that the viewers and listeners have a little bit of understanding of who you are. Just give us a little bit about your background, your current role, career path getting here, etc., and then we'll dive into our rapid fire questions that we always ask our guests.
So I'm global head of research for Newmark. Newmark, we're a publicly traded company. We're a full stack, all full services brokerage with operations, around the world. Although our primary business is in the United States. We do everything you can imagine touching a multifamily or commercial building, from we help you sell buildings. If you own the building, we can help you sell it. If you own the building, we can help you refinance your debt. If you want to buy a building, we can help you find the building that you should buy and help you find the debt to buy that building. If you own a building and you have vacant space, a lot of people do. Very, very popular thing right now. We can help you find tenants for it. If you're a tenant and you want to find space, we are eager to place you into that space. If you need a property management, we have property management facilities. If you're a corporation that wants advice on your workplace strategy, like how many days should be in the office, we have a consulting group that does workplace strategy. If you own a building and you need to report to your lender what the value of that building is, or to your investors, and so for your fund, we have valuation and advisory. And these are just a couple of the different verticals that come together to make us a full stack shop.
Got it. So you have a lot of expertise in this space, is the summation of that.
Newmark does. It remains to be seen whether I do.
Yeah.
Newmark certainly, though. So I'm head of research. What does it mean to be in research in this context? Well, if you are trying to analyze the market and tell people you should buy this building, was why you need to have a sense of what's happening in the leasing market, what's happening with rents. When you're talking to a specific tenant and you have to say, these are 12 spaces in this building that we think are worth doing for you. So you need to know about what are those space availabilities, what makes them competitive, what are other people doing in the market. So you need lots of competitive intelligence. I mean, at the end of the day, you need to know what are all the buildings, what are the rents, what are all the leases in them, when do they mature, what were the terms of them. Well, that's all research. Research does that. So we have a big primary data collection aspect to what research does. This is in contrast. So for anybody on Wall Street out there, research is in some ways like research at an investment bank. In other ways, it's very different. Like we write reports. I write reports that provide thought leadership and ideas for the industry. But in contradistinction to them, we're doing primary research as well, building new data. We also have vendor data that we integrate in. So it's, in that sense also, there is not a Chinese firewall between our deal professionals and our research teams. We work often as integrated parts of the deal team. So we're in the mix. We are front office. And so that's, I mean, it's kind of what we do. I mean, I think you were asking, like, how did I get to do this thing that I do now?
Yeah, just like your background. How'd you get where you are? It sounds
so I'm global head of research. That means all property types, the leasing side of things, and the capital market side of things, debt and equity. So my particular skill set, my specialty, is the capital markets. Prior to coming to Newmark to run the research, I was global head of investor insights at Cushman & Wakefield, which is another real estate brokerage. Prior to that, I was at McKenna Capital Management, where I was the right hand to the global investment strategist there. We had about 20 billion AUM investing across all geographies, all asset classes, primarily through third-party funds. So it was kind of a fund-to-fund structure, but with a direct component. In particular, we were in the strategy function, so inputs into asset allocation, but also analysis of risks and opportunities arising from global macro conditions. So, like, to put that in context, like back in the early 2010s, when Greece was blowing up especially, and there was a lot of concern about whether the euro would fall apart, well, it was my team's job, or the team of which I was a part, to come up with our view on that, communicate it to investors, and think about ways to de-risk the portfolio along those lines. We ran a $2 billion actively traded currency book. So I would say my background is in global cross-asset strategy. And then over the last, call it 8 years, I have been pivoting into specifically deploying these capabilities within the real estate space. Prior to that, out of college, I was an investment banker with Merrill Lynch doing corporate finance, debt advisory, and kind of special situations investment banking.
So you obviously have a very deep background in this.
You're the guy to talk to on this topic.
Yeah, which is great because we wanted somebody with a lot of experience to talk to us about the commercial real estate sector. There's a lot of headlines going on, what that might do to the economy with regional banks. We're going to get into some of those questions. So tradition on this pod, we always get to ask three fun questions. Again, just to have a little bit of humor with it. We call them our rapid fire questions. Keith will kick us off. So again, just real fast, just to kind of gets everybody to know how you think a little bit. So
let's start with this poignant question. If you were a superhero, which one would you pick and why?
I mean, this is boring, but it's just obviously Silver Age Superman.
Silver Age Superman?
No, not this watered down Superman. I mean the Superman that could travel faster than light to the other side of the galaxy and could like laser blast planets. Such a powerful Superman that they had to reboot everything and then and kind of wimp them out and go into the whole doomsday kryptonite cycle so they could nerf him. You can tell that
My man.
yeah.
Yeah.
This is a good one. This is similar to the time that somebody said, I would be Fat Thor. There's somebody an answer that they gave us once.
Also a great answer.
Also a great answer.
Yeah. You went into the racks for that. That was
I
a
like
good
that.
one.
That was
All
good.
right.
Yeah. So
I'm
favorite
a
book or
proper-
podcast
I'm
this
a
year?
proper researcher. I read
I can tell. You
comic
spent
books in the 90s.
that's
Exactly.
just to prepare for this podcast.
yeah.
That's
And for those of you under the age of 25, a comic book is this thing that was printed. Sorry.
Here we go.
Favorite book or podcast that you're reading right now or listening to that you think people should pay attention to?
I think that they should pay attention to. I try not to read
listen.
anything in my free time that people should pay attention to. I spend all day reading things that I think I and others should pay attention to. So, like, the book I finished last night is a Warhammer 40K book.
Yes. Okay.
Yeah. I mean, like, I've read like 8 of them in the
I don't even know what to say to that.
Yeah.
Space Marines. Space Marines. That's all. So look. I'm not saying you should read that. I can tell you that it's wonderful escapism. That said, if you actually do like intelligent sci-fi fantasy, I think that you should check out anything by Gene Wolfe. Gene Wolfe was a science fiction writer, kind of from like the 70s through the 90s. And he had the distinction of being really, really smart and like theologically and philosophically complicated. He writes esoteric novels with unreliable narrators. So there's layers of things going on, so it's like when you're reading, it's like uncovering a puzzle. There's whole forums dedicated to trying to figure out what the locked messages and interconnected were in his oeuvre.
It sounds like every dream I have every night. None of it makes sense at all.
Some of it's very surreal. But there is a tetralogy called Book of the New Sun. It's 4 books.
Oh, wait, what?
Tetralogy.
What?
What's a what is
4
that?
books, not a trilogy, a tetralogy.
A tetralogy.
I needed a cocktail before this one. I can tell you right now.
I started off with his short stories on a recommendation. The House of Cerberus is an excellent introduction. I mean, quote unquote serious fiction. My favorite post-war author is Cormac McCarthy. He's fantastic. It's very depressing but beautiful in that kind of stark way. If you've seen No Country for Old Men, know that was one of his more positive narratives.
Sure. That's a positive narrative?
The most positive it gets. Like it gets
one of the most
worse.
Depressing movies I've ever seen.
It gets worse if you read the books, but they're amazing. Anything by him is great. But what my point is that as a stylist, Gene Wolfe I would put in that category. And I do not say that about Herbert or Asimov, although they did good world building.
Okay.
You told me that it didn't have to be about real estate.
No,
we could have a
no, it doesn't.
It's so good. It's just like ask a researcher a question, get a researcher answer.
This is how I bond with my analysts. Like I'm just like
I get it. Seriously. You and Keith can nerd out somewhere.
We can. Yeah. When this is over, we're going to talk. If you could have lunch with one person, current or historical, who would it be?
Oh, Julius Caesar.
Good answer. Why?
Well, first off, because my undergraduate degree was in classics. So I've read a lot of his stuff in the original Latin. And he was the most baller motherfucker ever. No, like, if you read the Bello Gallico, which is his, like, literally, like, so here's the background. Like, he was consul in Rome. He's part of this triumvirate with these 2 other dudes. It's an uneasy alliance. He loses the fight. He has to go off. They put him in some shitty place in just north of Italy where there's no wars going on, so he can't loot and pillage. He makes a weird legalistic argument that actually he's in Cisalpine Gaul or is Trans-Cisalpine Gaul. He can go into Cisalpine Gaul and fuck them up. And so what? And because he has all these debts, right? Because he had to put on like fucking games for everybody in Rome. Yeah.
Triumphs and stuff.
So he's like, if he goes back, he's going to get like arrested. So he's got to get real famous. So he just marches off there with his legions and not only does he just fuck them up, like conquers this like unconquerable place in like a 9-year period, but he writes home every week from horseback. And Caesar appeared in the foe before him. So the man that I met in the
You've done your research apparently.
You
on
know
this.
what's funny
Yeah.
is
Yeah.
this.
what was it called? The Adrian Goldsworthy has something of a colossus. I read it in college. It's a fantastic biography of Caesar. Everybody should read that. And then you'll know.
I just watched a documentary on the Battle of Elisa over the weekend, last weekend, right? That's the one where there was the double.
Yeah, with Vercingetorix.
Got sieged.
Yeah.
Yeah. Crazy.
All right. Wow. Okay, I got to catch my breath. We gotta jump into some stuff here. Although we should do a pod on Julius Caesar. Apparently,
if Twitter is to be known and TikTok are to be known, there is a lot of appetite for more Caesar.
Okay.
There is. Yes.
Well, that was definitely the most interesting response I think we've ever had on the show for
facts.
That's 100%.
Great facts. I actually don't want to talk about commercial real estate, but we should.
We need to, because that's what we're here to do. So, all right, let's dig in. I'll take the first question. Keith can grab
go. Yeah.
The next. So obviously, there's a lot of headlines on commercial real estate having issues. Keith mentioned one earlier. It means a lot of things. So are we talking, these headlines is about commercial? Is it office space? Is it multifamily? Like what sectors are really these headlines focused on, and what should we be paying attention to?
I mean, it's really about office and multifamily. Industrial and retail are less of a focus area. The reasons for that, we can kind of like push them off, is like, so on the industrial side, it's just rent growth has been so strong for so long that even though they were actually, from a cap rate perspective, so the yield on the asset, you could try and generally kind of compare that to like a bond yield, for example, for the price dynamics. The yields are very low. The lower yields are, the larger the fall in price if yields go up 50 basis points, or they go up if they're down 50 basis points. They have what's called more interest rate risk. They have more duration. So like industrial buildings were trading in a lot of cases at least in place below like sub 3 caps. We were seeing things in the LA basin. It's very low. It's very, very low. On a spread basis, it didn't look that bad compared to like a 1% 10-year treasury, but it's like very, very low and has a ton of duration risk. So those have absolutely been hit. It's not that they haven't been hit by interest rate risk. It's just that if you have 10% NOI growth every year that you're holding a property over a number of years, well, it can countervail a lot of that and it can prevent value loss. B, it can definitely prevent so much value loss that you cut into the debt. Because, you would imagine, because most financings over the post GFC, at least on the senior portion of the debt, has been kind of 55 to 65%. Sometimes you'd see 70. Yeah, if people use pref and mezz, they can go higher, but it's, we don't have as good a tracking on that. So the point is that like you could imagine an industrial building where rents grew 30% in a period of time. They had they got hit with interest rate risk. Yeah. But they would need to sustain an over 35% loss before the lenders are worried. So that generally just hasn't happened a lot. And I have models where I run this stuff with all sorts of assumptions. On the retail side, frankly, I mean, the leasing market has been relatively well supported. The LTVs were really low, generally on retail buildings, because retail went through, like an old night. Like it went through an extended period where it was out of favor. And as a result, it had higher cap rates, generally lower LTVs. And then, since there was no supply that's been added, like there's been essentially no retail construction for years. After, obviously like a not so fun 2020, but then a very strong rebound in 2021 with, goods and services spend increasing. So that's been, there's no exposure, there's less exposure. Now, let's talk about multifamily, because we're going to spend so much time with office. Multifamily, the issue isn't so much about like a 2017 deal that was done with 10-year debt. You go back to 2017, the cap rates might have been in like, depends on the product, but like prime stuff, like the best stuff would have been trading in around a 4.5. cap rates. So, those cap rates now are at least into the fives. I would argue they should be I argue that generally we should see them into the sixes. But there's certainly large transactions. One may or may not have happened recently where everybody's speculating that the cap rate was somewhere in the fives. So things are happening there. Meanwhile, rents are very clearly up from 2017. So, even with increases in expenses and labor costs and, and insurance and all the rest of it, generally you still had NOI growth, fairly healthy NOI growth over that period. So that stuff, we're not too worried about that. Contrast. There were over $300 billion worth of multifamily properties that were purchased like in 2021.
Right.
So at, average cap rates that were south of a 4, some cases they locked in low debt, which is great. But frankly, like ever since the GFC, floaters are the main squeeze because interest rates have been on a downward trajectory. So there's been such a strong bias for people to float. And then if they want to get rid of their interest rate volatility, they buy like a 2-year cap. Well, so as a result, there is, less people than you would have hoped who lock their rates at 3%. So now.
Right.
So if we could telescope out just a little, right, before we get down to the granular. So what I heard you expressing in a couple different ways in multiple different sectors is when rates spiked over a 2-year period, you had people who had short-term debt durations at very low rates. And then when it recasts, if it's a floating rate, that means it's gonna spike up. Or if you're set to refinance and you financed it at a very low rate previously, now it's gonna be a lot higher. All the unit economics are the same for your property, for your building.
Well, and they can even improve. Right. They can even improve. But did they improve enough to offset the rest of it? And so that's a lot of the story of multifamily is that it's not that the fundamentals are bad. I think a couple things happened in 2021. People were getting incredible rent growth. And so they bought buildings at very high valuations, did their underwriting expecting 2 things to happen. 1, high rent growth would continue. 2, they would be able in their model to sell it at something similar to the cap rate they bought it at. Neither of those are true. Did not work. And a lot of the stuff that was done between the second half of 2020 and the first half of 2022 was what we call value add. You buy an older building and you say, I'm going to redo the units. I'm going to put X dollars per square foot in, and then I'm going to jump the rents. And then presumably like a lot of this is being done, but you get out, you sell it. You sell it off to a core investor, and then you recycle the capital. You do it again because that's where you're trying to make mid-teens IRRs, and that's how you do it. Or folks were doing development, into a growing rent growth. So just think about the underwriting. I borrowed
now in commercial.
Sorry.
In the commercial space, it's weathering it the worst. Is that the case? Is vacancies are up?
Vacancies aren't up because of debt. Vacancies are up because of the enormous amount of supply that's being delivered into multifamily markets. Gotcha. It's not that we've seen a decline. We haven't seen like a decline in like leasing, for example. Demand as opposed to is still generally like pretty good. We actually had 2022, some of the main data sources showed some negative net absorption. Kind of confusing, not quite sure what was going on with that, but most of the projections are that we'll have fairly healthy net absorption. Part of this is because there's a lot of people, myself included, who are going to keep renting rather than buying because, everybody listening to your podcast probably already knows about that, but there's plenty. It's never been cheaper to rent relative to own, ever. Ever. There's no,
because of values and
I was just having this conversation with a friend of mine last night. We were out mountain biking and we're both in real estate, and we were like, we don't know how anybody affords anything in California where we are. We don't even, I don't know how it's possible. It's just insane the amount of how expensive housing is. And
There's a solution.
Yeah.
The 100-year.
Well, that's exactly it. Well, and California is always fucked because we have a tax wedge that arises from Prop 13.
Yes.
Yeah.
Right.
So,
but in the office space, is that the darkest?
Yes.
Is this the darkest hour of everything we've talked about?
By
because of COVID, vacancies, work from home, remote work.
I mean, look, we've seen over 250 million square feet of negative net absorption over the last couple of years. And
that's a big number.
And that's material. And and only about 30% of pre-pandemic large leases have come up for renewal.
30%. So only a third of. So 70% more.
Yeah. So I mean, and look, you can see it in the charts. Like historically, office using employment goes like this. Net occupied space goes like this. Because you hire people, they need space, it drives demand. Recently, office using employment has gone like this, and net absorption has gone like this. That's not
bad. I'm no economist, but
no. Like that's not because people who hire don't need office. It's that they need less office. So like if you were modeling it, like the coefficient, the relationship, the correlation, or the beta, between office using job and office demand has gone down. Another way of parameterizing that would be like you need on average less space per worker. And that's a result of could be the way the footprint's done, but more it's about like how often people come in and trying to solve towards their actual space needs. So that's proof positive that we're still going through a period of adjustment, that this is going to be a headwind for the sector for an extended period of time.
What are you thinking? What kind of period? Yeah, how long are you talking about? And like, how bad are we talking here? Because that one line this way and the other one the other way, in simple terms, is not good.
No. Well, it's a problem. It's a problem, and obviously there's regional variations. There's different segments of the market that are more impacted than others by this stuff. So the devil's in the details. But overall, like I would expect that we're going to. It's going to take a few years for the office market to stabilize. Now, one of the things that's helping is that there's very little new office construction.
Mm-hmm.
We had a pipeline of 115 million square feet on the eve of the pandemic. That's down to like 40. We think it'll go down to 20, and that's in a market where trophy space, new delivered product is outperforming. So.
What are those Are they pivoting to resi and turning those sites into apartment buildings, or what? What do you do?
Well, basically, like if you got it zoned and you bought a piece of land for something and you already broke ground, you're generally not going to like convert. You're also generally not going to just like shutter the deal, because in this case you like already have the construction loan and all that kind of stuff. Like it's all in there. It's more like top of funnel just dries up. Yeah.
Where do you think the exposure is? Is this regional banks? Is that we keep hearing about regional banks have a lot of exposure in this?
They do.
Potentially, you could see some shutdowns of regional banks that collapse because of it. Is that clickbait? Is that real? Like, what's your take?
I think it's very real. I would argue. I mean, frankly, like a lot of the headlines you wrote, at some level, degree, were dependent on work that I did. Like quantifying things. I mean, anytime you saw numbers, like some of that was some of our reports. Here's kind of the landscape. All banks are about half of commercial real estate finance. And I'm including in that both commercial buildings and like 5+ unit multifamily developments. So not duplexes, but actual apartment complexes. So it's very bank heavy. Multifamily is a little different because the largest lender is the GSEs, Fannie and Freddie. So they're a little bit less bank exposed because they have that balancer. That's part of the reason we have the GSEs, is to provide additional stabilization to the financing market. So then within that, 2/3 of the bank loans are from regional banks. All right. So what's happening then is very, very important. I would say that they're quite heavily exposed. In general, they do high quality, like Class A type financings, but a lot of those regionals in particular, and even the small community, like they're lending on like very old product that, sometimes this could be a benefit because we've actually seen tertiary office markets perform relatively better. In part, that's because like there's less competition from new space. There's less of a trend towards work from home, just in the nature of their occupiers. But, the end result is that like from like if you're saying like Class A, Class B, Class C, like a lot of the regional bank portfolios are skewed towards lower quality assets.
So follow up on that. We're basically, I think what you're saying, I'm not putting words in your mouth, is there's obviously going to be some turmoil with regional banks that are potentially ahead. And is this going to cause is this where we go back to Silicon Valley Bank collapse and then there was Fremont and others? Like, you think the Fed steps in on this? Does it become an issue? Is it a talking point this year in the election? Like, what's your overall view on
that?
I mean,
if we went into a distress period where it seemed like, markets were shutting down and there was contagion effects, then I would still expect the Fed to do something. I mean, it'll depend on the particular reaction of what's happening. I don't know quite on the time scale because the regulators have been, at least since last summer, instructing banks not to recognize losses on their real estate loans.
That's one way to fix it.
What? They saw their comrades over at the People's Bank of China, saw what they were doing, how they handle these things. And they're like, you know what? They could have had a real estate crisis immediately, and they just they obfuscated it down. So I'm joking.
We understand.
Yes, you are.
Kind of.
Yes. If anyone from the SEC or governing bodies is listening, we're just having a little fun on the podcast.
Mm-hmm.
No, for real, why? And I'll walk you through the problems of the mechanics. Is that they put out guidance on CRE loans. They said you should work with your borrowers, which is good. It is good to work with your borrowers. What's not good is that you go to the first 10 examples in their appendix of like how they would actually like monitor loans. And they're like, well, if the loan's underwater, but they're still making their interest payments, that's okay.
Just don't recognize that loss. That the loan's
the phrase
underwater.
Is criticize the loan. If the loan is criticized, then that you need to take loan loss reserves against it. Loan loss reserves come up as a liability. They hit your income statement. They flow through. They reduce your equity. Like from an accounting standpoint. And the idea is that they mean that if you wanted to sell that loan, or then when you later if you ended up charging the loan off, you had already taken some of the capital hit instead of it happening all at once, right?
So this is that phrase, extend and
That's exactly what it is. So they said extend and pretend. And part of it had, and the thing that I was telling people is I was like, what this systematically represents is it's a bet of double for nothing. Like it would look like a brilliant move if the Fed ended up cutting rates by 300 basis points this year. And the financial engineering problems, if they didn't go away, they were sharply mitigated, right? Mm-hmm. But if that doesn't happen,
you're just putting more air in the
yeah. Well, I mean,
you're just making it bigger.
All a bunch of
How big of a number are we talking? You've done the research, I'm assuming. Like, what is the potential amount of loss we're talking about?
Well, I don't have the exact loss number, but the number, just to my fingers, I have a model where I could estimate the amount that are underwater. But what I can tell you is that, in our estimation, if you look at loans that are maturing this year, next year, and the following, we think that across sector, this isn't just regional bank holdings, this is the whole sector. We think there's about $670 billion worth of CRE debt that is undercapitalized.
Oh, Jesus.
Undercapitalized.
660 billion?
670 billion that is undercapitalized. That doesn't mean that it's underwater. Some portion of that is underwater.
Sure.
But it's
Yeah.
But you could not refinance that loan in the market today with its current parameters.
How much more runway is in this extend and pretend? I mean, do they do that for another 2 years?
Nobody knows. I'm serious. Like, I thought that more would happen already. Would have happened already. I'm like, This is ridiculous. How has this not happened? And I mean, look, I'm in the transactions business. Like, if these things that we have to sell the loans and refinance and find JV capital partners like that, like, I'm fine with that. That's great. In fact, like, we have better brokers on average than the other folks. We have the top people in the industry. Like, this is great for us because we'll differentiate because it's hard. So like, even my own commercial alignment, I'm like, I just want transactions. So this extend and pretend business is like, I find it intellectually offensive, but like, it's also like,
Yeah. That's wild.
I actually love that. That needs to be one of our quotes. I find it intellectually offensive.
We'll put that on the merch list.
So Keith, you were tracking some stuff with Blackstone. Talk about
Blackstone. We're pivoting a little away from commercial now. Because Blackstone, I just read on April 8th, they announced a $10 billion with a B, $10 billion purchase of AIR communities.
I got to be careful. So like, they are a client. I cannot comment on specific things to do with not only a client, but a very large client. Well,
let me not make it about Blackstone then. Let me ask it in this way. If a large player is making sizable bets, does that mean that their perception is there's some sort of bottom and redeploy?
Yeah, I mean, look, I mean, Bloomberg was saying, like, they were covering comments from a number of people who said, we believe we're getting close to the bottom. And you don't wait to time the bottom. You have to deploy capital into the bottom because it's not, well, I mean, frankly, like, even if it's your personal portfolio, like, you're not Julius Caesar. You're not going to survive double envelopment. You just kind of got to like start putting the money in. You got to dollar average into the market.
Yeah. Particularly,
if you have a lot of capital and there's a lot of dry powder out there that's been waiting to deploy. So I do think that there's a sentiment that we are nearing the bottom and it's time to start putting things in. So I agree with that. Like, I think I do think that you should start deploying. The argument that I make to folks is that the problem people are in right now is that they're spending 80% of their time on legacy assets, 20% of time buying things at half of replacement cost, and at 7, 8, 9 caps, which gives you unlevered, like low, 10, 11, 12, low teens, returns. Like, that's sweet. Like, I mean, the 10-year was yielding 1% a couple of years ago. Like, this is great. You should buy more of that stuff and not spend all of your time on the thing where your basis is toast. Yeah. So that's, but the incentives are complicated because if your lender is terrified of taking back the asset and doesn't want to do it and is feeling very little pressure to do so, whether it's from the regulator, and the capital requirements, or in some instances, like from their LPs, then if you're holding the building, as long as it's cash flow positive, like you're not paying out more in interest than you're taking in, well, you're getting some return. It's not a great return, but you have an upside option. So this is where the strategic behavior gets more complicated. You're like, this thing is paying me money. And at some point in the next 40, X period of time, rates could come down and then maybe I'm in the money again. Right?
Right.
And then, so you ask yourself, like, what is my highest IRR? Like, well, like, if you think you have zero equity in a deal and then you get a little bit of equity in a deal, going from 0 to 1 is like a very, it's a huge IRR. Right?
Yeah.
So as long as you're not spending all of your time fighting with the lender every day, and you're using third-party property management, or you have asset management people who are like handling the day-to-day, and it's not just absorbing your stuff, then like, yeah, I can sit there and be like, well, yeah, it's a free option. Like, you shouldn't I don't see why you would like aggressively sell that, especially if you're not getting proceeds that you can recycle. Now, if you actually haven't now there's other cases where you still have equity of gains in it. I would say like it's unclear to me, given that what you have is a financial problem in the building, like your basis is too high. Like I would get out of that and go into something with a much lower basis and a cleaner shirt, right?
Just take your lumps and
exactly. And I think it's the same thing if you're looking at banks who have things on their loan books. Like I think that they would be better off like not, banks would have been better off like being very honest about like what their problems are with some of their debt and beginning to offload it.
Yeah.
Because that would have given them time to like recapitalize. So like if you spend and pretend and then you have to stop pretending all at once, well, now you have much greater solvency risk than you would have otherwise.
Yeah.
Like all these banks have been paying dividends and raising no equity capital. Like literally, had they been taking loan loss reserves, they could have been rebuilding. They could have been like, you know what, we're going to deal with this. We're turning off the dividend. We're going to build this capital buffer and do this, and everything's going to be fine.
Right.
That would have been good.
Just find a reset button.
That would have been.
We're gonna find the bottom.
That would have been good risk management. It was not what they did.
Let me ask you a question, because Keith will wrap us up on a few final questions here. What I wanted to ask is, do you think that, I don't know, my question is, did COVID and just the shift that occurred from companies being forced to work from home and like figuring out their systems to do that, is that a permanent shift? Do you think that it's going to go back the other way? Are you seeing signs where companies have went, like more companies are going to come back to the office space? And then like a follow-up to that is, do you think commercial developers are a little more timid now, having gone through that? Does that make sense, my question?
Yeah, I mean, look, there's very little evidence of like a huge sea shift in like working trends. Like hybrid is the dominant paradigm. We have seen fully remote job positions go down. Like there's, if you look at like Indeed put out some cool data on this, looking at job postings numbers for fully remote, fully in office, and hybrid.
Sure.
The hybrid share has grown, the remote share has gone down, and the full time in office has been stable or slightly up.
Interesting.
I think there's some data that you could see. I mean, the data picture is very imperfect. A lot of people use Castle. We use Castle as well. There's multiple issues with that data being fully representative. For one thing, they don't adjust for changes in the number of employees in a building. They don't adjust for the occupancy of a building. They have, we don't have good statistics on how many buildings they have in their set and how representative they are. Like a lot of folks tell us that they have primarily like Class B buildings. Like they're not owning the same stuff the REITs do, for example.
Mm-hmm.
There's a few other data sources, but, and there's also like big social survey data, like Nick Bloom at Stanford does a monthly survey, then they've been doing it, for a while. And again, it just doesn't show a lot of changes in expectations and behaviors. So what I tell people is that I'm like, don't count on a major shift in behavior. I think we're already in the new normal on behavior. Now there'll be like fiddling around the edges, and there'll be certain occupations that change this or that. But overall, I'm not expecting the balance to change radically.
Interesting.
Yeah.
So
that we are where we are, and it's not going to be a radical change.
Mm-hmm.
Okay.
Yeah, I mean, my buddy's fiance works at Apple, and she's the hybrid. It was 2 days. It went to 3. Pretty much going to stay that way. So a couple days at home, 3 days at the office. And that tends to be what we're hearing in the Silicon Valley market.
Yeah, and I think that's largely representative. I mean, I think, and 3 days is an important fulcrum point. Generally, if people are in more than 2 days, they're in 3 days. It militates against going to a hoteling system. If you hotel, then space requirements can come down pretty dramatically. With assigned seating, even though people are using the office less intensively, you still need it because you have to solve towards peak utilization, and everybody's got a spot. People in general don't like hoteling. I remember already in 2020, they're like, everything's going to be hoteling. I'm like, everybody hates hoteling. Hoteling sucks. It's not fun.
Yeah.
I mean,
I need my pictures of my family and
Yeah,
my
it's also
dog,
why I have a chiropractor
Oh, yeah.
every week.
Yeah. I mean,
Yeah.
yeah. So I was always skeptical of the widespread hoteling thesis. Now it happens to some extent, but it's a factor. But yeah.
All right. Well, we're getting towards the end. I want Keith to wrap us up with a final question or two. So
yeah, this is the question we always ask at the end, and I'm interested in your answer. So you got to put your residential real estate broker owner, if you owned a real estate brokerage, if you were a residential real estate agent today, and I am excited about your answer. What's one thing you would do or implement if you were in our space? What would you start to help your business in 2024?
To help your business.
Yeah, whether it's to help you sell more houses, to help you build a better real estate brokerage.
You could also apply it to a commercial real estate agent.
Yeah,
do that.
true.
Take it to a commercial real estate agent. I'd love to hear your answer
if
on
James
that.
and I were launching a commercial brokerage tomorrow, what should we do? You want to do it? What are you doing tomorrow?
He's like, read Julius Caesar first, and then.
Well, I mean, I think this is so pat, but I really do think taking a data-based approach is like very, very important. Like really try to be like in the weeds on the data and digital native. One of the things that I spend a lot of my time on is working with our technology team to try to capture more data. I mean, the picture that I give is that all of the commercial real estate brokerages are running around with a double-paned coffee cup available for $19.95. And they're running around in a rainstorm trying to capture the information that's actually flowing through the organization. When you have thousands of brokers out there having conversations with clients every day, looking and reading, they have so much knowledge, and you capture so little of it. It's a torrential downpour. You capture a little bit, this might keep me alive for the day, So we're trying to solve, trying to solve the problem of how can we collect more of the intelligence, structure it, and make it available so that we can provide the best advice.
Yeah. It's a good one.
Which is a great corollary to any business, right?
Yeah, and every business and it's very difficult. If you were starting a new organization, you would try to build that in from your DNA to begin with. Both commercial real estate brokerage and, not quite to the same extent, with residential brokerage, because you don't have as many repeat buyers. It's a lot more one-off or broadly spaced transactions. It's more comparable to what our private capital brokers do, who work with a dentist who buys or sells something once a decade. In game theory, you would say it's more like a one-off game. But there's still this dynamic where everybody has their turf, and their payment structure is commission based, which makes people highly motivated, but it doesn't incentivize sharing and collaboration. At a fundamental level, it doesn't. It doesn't. So I'm not making a comment about the personalities or any of those things. I'm just saying that your basic incentive structure in your organization is not favorable towards working together and sharing.
Yeah, independent contractors running that shit. Yeah,
and I don't think that is fit to purpose for the world that we're in. I think that entities that find ways to align their incentives so that they capture and store more information, that they cross-sell more effectively, that they use their relationships to open up opportunities elsewhere in the firm, are going to be more successful over time. Yeah. And so my advice would be to look for opportunities there, sell together. You can even imagine, look, you're a residential real estate broker. You're representing the seller in a couple different properties, right? There are other houses, in theory, that might be a better fit for the people that you have coming in at the top of your funnel, right? If you found a way to actually put the right person in the right house, which is good in another ways because the person in the right house is going to end up paying closer to their maximum price. Like I'm gonna pay most for the thing that is closest to my preferences.
To what
exactly
you want. Right.
So you not only like again to be intellectually salutary or salubrious. Intellectually salubrious it is for me to think about markets where we find to capture more of the consumer surplus, get people as close to to their matching as possible, efficient markets and all that.
It is inefficient. It's an inefficient information
exactly
source, right? Because the boots of the ground are so fractured and so disparate. Man, this was a great conversation.
Yeah.
I really appreciate you.
No, it was good. We got more F-bombs in this episode than I've done so far this entire year. So there's that fact.
I just want everybody to know that this was a goal that we set early before this. So I feel like it emerged fairly organically from the conversation. I will tell you like a quick little vignette about that. So I have always had a foul mouth. Ever since I was a little boy, I had a foul mouth. I had a foul mouth in college, and then I went off to investment banking, and I was very concerned that I'd have to become like professional and dry. And then
you watched Wolf of Wall Street.
I lived Wolf of Wall Street. Not some parts of it. I won't tell you.
Really? Because we should have that podcast.
Which ones? I won't tell you which ones. But I never had a Ferrari, so that's unfortunately I wasn't quite that
Lamborghini.
Yes, Lambo. But anyways, the point is, I remember getting on one of my first conference calls, and an MD got on, and he's just like, "Fuck this is bullshit." And I was like, "Oh, thank God, I'm gonna be all right."
You're like, "I'll be okay.
I can do this. I don't have to change."
It's funny.
Well, it's important to be able to be yourself. We love doing that on our pod. We appreciate you being yourself. We learned a lot, and we'll definitely have to have you back. And hopefully the predictions everybody's making aren't as scary as some of the numbers you said, and we'll find out, I'm sure, soon enough. So again, thanks, David, for being here. We really appreciate it.
Thank you. Thanks. My pleasure.
It's our job to say out loud what everybody's only thinking to themselves. It's your job to subscribe to this podcast so you never miss an episode.